Part of the thing with GAAP is filing a thing called a profit and loss, or P&L. And publicly traded companies have to do this. Most corporations have to have some level of a profit and loss statement. Profit and loss basically is a summary at the end of a period, sometimes a fiscal year, sometimes a calendar year, that says this is how much we made, this is how much we lost over the course of a year. When I went to college and discovered profit and loss statements, I went, well, if businesses have to do it, how come I don't do it for myself? And I started doing an annual P&L on myself. And basically it's, some kind of fundamental accounting. We've got the minuses over here and the pluses over here. I don't do it as debits and credits. But the minuses are liabilities like loans. And the pluses are things like savings and assets. And if you add these things up, the question is, do you have a negative or a positive at the end? And when you start doing this and you start saying, by golly, these things over here can be quite expensive and why do I have them? You tend to have more of this. And that has made a huge difference in my life. Let's put it that way. In any case, businesses have to do this. And if you look in their profit and loss statement, it's usually somewhat complicated to sort through things. But you start looking at this, and this tells you something about what the business is doing and whether or not it's doing well. Now, ways that businesses can, I wouldn't say lie, but make it unclear as to whether or not they're making a profit. If you start out with $100,000 in inventory, and at the end of the year you have $10,000 in inventory, then this decrease in inventory that you sold off means that you have more cash, but it also means you have less assets. And those are the kind of things that you need to sort out of the P&Ls to kind of try to figure out the other details of what the business is doing. Now, businesses that are growing quarter over quarter, year over year, are worth more than those that are not. And when you look at these P&Ls and these statements and all these things, what you're really after if you buy a stock is what is the free cash flow. That is the determining factor on the future value of the stock. And things like this are hard to sort out, but they're critical because the free cash flow is how much money did they really make. And when you buy a stock, this is what you're purchasing in the future, is that free cash flow. Now, if a company has lots of free cash flow, but you did a bond and you purchased and lent them money, you don't get any benefit from that. You get the discount rate on the bond, which is another reason why I have very little interest in bonds. I have most of my interest in stocks because, I want to pick companies that produce free cash, I want to get them at a reasonable price, and I want to participate in that future cash flow. So this is the profit and loss side of the picture. It makes it difficult to sort through what makes for a good stock. I mean, there are these indications like price to earnings ratio, the PE ratio of a stock. And, this is one that's reported if you go to Google Finance or things like that, you can find the PE ratio. And you'll see stocks that have a PE ratio of 10, as in the stock is worth 10 times the amount of earnings. What does that mean? That means you probably have a stock that's over here that's not growing, actually. And you have stocks that you see are maybe 40 times. This means that you probably have a stock that's growing. Is it growing commensurate with having a PE of 40? Sometimes you see stocks that are 100 times their PE. Okay, a PE ratio of 100. Wow. Could be absolutely worth it. And this is not necessarily, the PE doesn't reflect a lot of these kind of things over here. So it's not really a tremendously good indicator of the value of a company. But, it is an indicator. You look at things. Another thing that a stock can do is, let's say you own a share, and that future cash flow, instead of it just being something that the company keeps, they pay you a piece of that out. So they pay out a dividend. Okay? Generally speaking, although not always, well-established companies pay dividends. And those dividends are actually income that you get to keep. There is ways that you cannot keep it. There are dividend reinvestment programs where you get the dividend, but instead of them paying you the dividend in money, they pay you the dividend in additional shares of stock. So you grow your amount of stock. The nice thing about dividend reinvestment is that since you are not getting money, you don't have to pay taxes on it, at least not now. Later on, you may have to pay taxes on it. But this dividend, some company like Black Hills Energy, it has a dividend, I think, of 1.9% or something like that. So it takes 1.9% yield, that's the percentage compared to the price of the stock, that it pays you out as a dividend every quarter, every year. Sometimes they're paid yearly, sometimes monthly. Some other stocks, like Philip Morris International, pays right now about 7.8%. So is this a good amount? If it were 8%, it would double in about 8 years just from the dividend. So yeah, that's a good amount of money they're paying you out. AT&T pays about this amount too right now. So some of these things you've got to ask, what is my risk for getting this reward for being paid for this thing? Black Hills Energy, my risk is probably pretty low. Utility companies are going to be around next year because people still want to heat their houses and have electricity and nice things like that. AT&T? Well, maybe. What about Elon putting up a satellite network so that they don't provide, or so that he can provide internet access? The AT&T may have some serious competition coming up. On the other hand, you look at the track record of some of these companies and you say, well, yes, but they've been paying consistently dividends for years and years and years. And then the question is their free cash flow enough to cover the cost of their dividends? You don't want to be involved in a company where they're borrowing money to pay dividends. That's a bad thing. Okay? Unless it's just some weird one-time event. Weird one-time events. Corning used to be the supplier for breast implants. And some of their breast implants were failing, and they had to pay out a whopping big chunk of money one year. And they had to borrow money to cover that because of bad breast implants. They're no longer in that business. That's an example of a one-time event that you go, yeah, this company has been paying dividends for years, but they had one bad year. That kind of a thing I can look at and forgive. A company that their income has declined and they're still paying the same dividends, that's bad news. Bad news. You want to sell that one and get rid of it. Find something else. So there are these things called dividend aristocrats. And these dividend aristocrats have been paying dividends for decades consistently. And some of them are things that, just are not likely to go away. There is a real estate investment trust, and it's one of these dividend aristocrats, that only does stuff where they lease the property to the federal government. Let's think about this. Is the federal government likely to go under and not pay for their leases? No, they're really likely to pay for their leases. So where is the risk? And they have been doing this for decades. So, there are things like that you go, yeah, this just doesn't seem to have much risk. And it pays a decent reward. Now, these things that pay dividends don't tend to grow as fast as some other things. I don't say that this is the only thing to invest in. But you look at stocks that are dividend paying and they do pretty well over long periods of time. And what kind of value do you get for this sort of thing? When I was in college, yes, I worked here at the University of Wyoming. And one year I got interested in stocks and I saved $2,300 that I invested in a number of companies and kept reinvesting it. Some of them were growth companies, some of them paid dividends. Did I lose money along the way? Yeah, I invested in stupid things too. But 20 years later, that $2,000 paid for one half of a $169,000 boat. So $2,300 was worth a lot more later. And if you do this repeatedly, you come out way ahead. So my recommendation about P&L statements is don't just look at companies. I would say you should probably sit down every year and say, am I better off this year than last year? Because you can be broke and make hundreds of thousands of dollars a year. But if you take some of that money and you actually save it for yourself, the money you keep can be very valuable. And if you make that money make money, over time, it's a lot. Okay? But you've got to be consistent. And you've got to, use intelligence and analyze companies and figure out how to get the free cash flow and figure out whether or not the companies that you are now a part owner in are doing what they're supposed to do. So there's some effort involved, but over time, it's a good thing. And this isn't the only way to invest. I've also made money in real estate. I've probably made more money in real estate than I have the stock market over the years. But when you start looking at it this way as I'm actually going to analyze it. I'm going to look at what the companies are doing. I'm going to look into the future and say, are they doing what they're supposed to do? Are you going to get it wrong sometimes? Yes, but most of the time, an intelligent person can figure out, yeah, this really is a good thing. Or this company really is making money. Or, yes, this is a sound investment. You hear all the time of people saying they invest in the stock market and it's kind of like gambling. This is not gambling. Okay? Yeah, there are people out there that are just kind of like, yeah, that's gambling. This is not gambling. This is using intelligence to look at the past and look at what they're doing and predict accurately things in the future. And is there errors and risk in predicting the future? Oh, always. Always. But, there's also good predictions of the future. Like, here's a prediction for the future. Will companies that build things like seawalls to protect cities on the coast have a bigger market in the future thanks to global warming? Well, yeah. Lots of people are going to build lots of seawalls in the future. So would a company that's building seawalls probably have a growing market share and be able to make lots of money and have a good free cash flow? Yeah, that's likely. So I've looked at the world and I've said, here is something that I'm looking for. That if I see a company like this, I'm going to be asking, are they well run? Do they do a good job? Are they building good seawalls? Okay? And are they priced in a fashion where I can make a profit from becoming a part owner, as in owning stock in a company that's doing this thing? So, you look at it intelligently and you can figure out what is making money.